So this next lecture is basically the next third of the course. Okay, so the next third of the course, it's going to be on the in-class exam. Okay, and what it does is it overlaps what we've done already. We go into some new material. Okay, and then it will overlap into the last third of the course. Okay, and I believe that this lecture is probably the most important lecture because the model and the methodology can be used in multiple ways of making investment decisions, either capital budgeting decisions, which you're starting to learn now, but also investment decisions. We can use this methodology to value a company that we're going to take over, or that we're going to buy. We can use it for capital budgeting for equipment that we're going to buy. We can use it to value stock that we're going to purchase. It's the same methodology, but just modified. So it's very useful, and there's a lot of utility to it, and it's the standard. Okay? So what I do is I call it financial integration. And the reason why I call it financial integration is it basically within one lecture integrates pretty much the whole finance concentration into an hour's lecture. Because we as students think of things compartmentally. We think about our classes as standalone, we think of the books as standalone, we think of the chapters as standalone, but they're integrated. Okay? And then once you understand how it's all integrated, you have a complete 360-degree view of how it works. Okay? Instead of just doing little exercises here, it's how it all fits together. Okay? In financial integration is understanding macroeconomics, open market operations, yield curve dynamics, risk-free rate determination, and how the risk-free rates are then used to determine the cost of debt and the cost of equity. And when looked at the firm's balance sheet and its capital structure, you can calculate the weighted average cost of capital, which becomes the discount rate, to discount the future cash flows, to get to the net present value, and internal rate of return for investment decision making. So it pulls it all together. And I'll be able to get through probably about 80% of the lecture tonight, and then I'll go back and I'll put together an investment decision making matrix at the end for you to be able to use, and then we'll go through that in the you'll go through that in the in-class exam. Okay. So the first step is understanding yield curves. And we've already done this. Okay. And we know that the yield curve is upward sloping. You have the yield to maturity, and you have maturity. We know through the Fisher equation that nominal interest rates, which are also called the risk-free rate, and nominal interest rates are real rates of return plus inflation expectations. Real rates of return do not change in the short run. So basically movements in interest rates and movements in yield curves are determined solely by changes in inflation expectations. So if inflation expectations go up along the curve, the risk-free rate, the yield curve, will shift up. And if inflation expectations go down, interest rates and the risk-free rate will shift down. And if you look at the impact of these shifts in the yield curve, up and down, or more specifically, look at the movement in yield curves, particularly on the short end of the curve, as the Fed starts to sell bonds and drive bond prices down and interest rates up, and maybe oversell those bonds, causing the yield curve to invert. If the yield curve inverts, You usually have a peak in the stock market within 12 months and you're in a recession in 24. And you can really see the impact of these risk-free rates, because the risk-free rates are a component of the expected returns, or the cost of capital. It's the base rate. It's embedded in your discount rate. It's embedded in your cost of debt and your cost of equity. It's embedded in your expected returns. So if you know what the cash flows are in T+1, and you've seen the yield curves shift up, flatten, or invert, then we know that that's going to cause the expected returns to go up and the values to go down. Also, +1, I minus G equals value. Well, if we know that we're going into a recession, then we know that cash flow growth rate expectations in the future are also probably going to go down, which is going to drive down values. We also know that cash flows +1 multiplied by the multiple also equals value. We know that the multiples are also 1 divided by I, or 1 divided by I minus G. So if these risk-free rates that are embedded in these expected returns go up, then the multiples go down and the values go down. We also know under the discounted cash flow, which is your cash flows, T plus N plus your terminal value, 1 plus I to the N, plus your cash flow in the last year, 1 plus I, 1. We know that if risk-free rates, which drives inflation expectations and expected returns up and down, we know that if this goes up, your values go down. So basically, it is the yield curve that determines the risk-free rate, which is the base rate in the calculations for the expected returns, but also for the cost of debt and the cost of equity of firms. So the question then becomes, how do you calculate the cost of capital for the firm to then derive the discount rate, discount back the cash flows on whatever you're trying to acquire? And we're going to pretend like we're IBM tonight and we're going to buy a tech company, okay, and go through the investment decision-making process. So the first is we need to figure out the cost of capital. Does IBM have bonds that are currently being traded in the marketplace? Do they have bonds? Does IBM use bonds to lever up their firm?
Yes.
Yes, they do. IBM's been around a long time. It's been very profitable. It's been able to grow their dividends constantly over time. And they've been able to use bonds to lever up the company based on the cash flows, to lever up the return on equity, and return, provide a return to their shareholders. Okay, so yes, they do. So we need to come up with the cost of debt first. And let's say that we are going to issue bonds, we are going to issue stock to acquire this tech company. Okay, so we have existing bonds and existing stock that's currently being traded in the market, that's highly liquid, so we could issue those bonds and issue those stocks to use that money for the acquisition. So we have to come up with the cost of debt. All right. So to come up with the cost of debt, how do we build the cost of debt? If you were asked to build us cost of capital so we can get the discount rate to do the investment analysis, how would you come up, how would you construct the cost of debt? We need to estimate what the cost of debt is going to be for this issuance. How would we come up with the cost of the debt? what would we do? How would we construct it? What would be the equation to come up with the cost of the debt? And let's say we are going to issue 7-year bonds. Maturity is going to be 7 years. So what's the first variable in the equation to construct the cost of debt? What's the first variable? Okay, you need to burn this into your brain, okay? You've got this lecture you have to memorize, okay? So what's the first variable within the calculation to estimate and calculate what the cost of debt would be?
Interest.
Yeah, but what's it called? What's it called? You're right, but let's take a step back. What is the base rate that I would start with in the equation to start to construct the cost of debt? Say it louder.
The risk-free rate?
That's correct, the risk-free rate. Okay. And the risk-free rate in this case is going to be what? 7-year what? What type of security? What are we using? What bonds in the marketplace right now are considered risk-free? Who issues them? The Treasury securities, correct. Okay. And so I would go to the 7-year Treasury security and look at the yield of maturity and use that as the risk-free rate. Okay. Are we done? Is IBM riskless? No. So what risk premiums would you tack on to the base rate, the risk-free rate, to construct a cost of capital for IBM, for the 7-year bond issue that they're going to issue? What risk premium? What kind of bond is this? Is this a sovereign bond? Is it a corporate bond? Is it a muni bond? What kind of bond is this? Is it a muni bond? Is it a sovereign bond? Is it a corporate bond? Who is IBM? You need to try to participate here. I need feedback.
Corporation.
Here. It's a corporation, so what kind of bond is it? Corporate bond, okay, excellent. All right, so what kind of risk premium would we tack on? Are corporate bonds risk-free? No. So what's the problem? What could happen to a corporate bond? What could happen to the bonds? Huh?
Inflation rates change.
Okay, so there might be an inflation risk premium. If IBM is highly sensitive to changes in interest rates, particularly on its debt, then you would probably want to put it in an inflation risk premium. Even though in the risk-free rate we know that inflation expectations are already embedded in the risk-free rate, but they may be more sensitive. Okay, so we have one. What else? Is that it?
It could be devalued somehow.
Are corporate bonds riskless?
No.
No. What's the biggest problem with corporate bonds? What's the biggest problem? What's the biggest risk to corporate bonds?
Going out of business?
Okay, if you go out of business, can you pay your bondholders?
No.
Bankruptcy.
Okay, so what happens to the bonds? Well, bankruptcy doesn't happen right off. You have to file a lawsuit against the corporation before you can go to bankruptcy. There's procedures. You can't go straight to foreclosure. I mean bankruptcy, you have to do something first. So the company is going out of business. What happens to the bondholders? Are they getting their money? No. So what happens to the bonds?
They're valueless.
They go into what? They go into default. Default risk premiums. Credit default. Company doesn't have money to pay the bondholders. They go into default. The bondholders file a lawsuit, and force the company to liquidate their assets. They sell the assets, they pay off the bondholders first. There's nothing left, the shareholders get nothing. All right, any other risk premiums that need to be taken into consideration when building the cost of debt?
For the change in market,
Are IBM bonds government bonds?
No.
No. How big is the government bond market? 19 trillion?
You.
Yeah, are bonds outstanding by IBM 19 trillion? No, probably not even close. So do you think there could be a liquidity issue in their bonds? I mean, if we go into a severe recession, are people gonna buy IBM bonds, or are they gonna buy US government-backed securities?
Yes.
Okay. So do you think there's gonna be a liquidity problem?
yeah.
Yep. Illiquidity. What's the maturity of this bond? 7 years. Now, movements in interest rates, do they affect long bonds more, or do they affect short-term bonds more? What bonds are affected more by movements in interest rates? Long maturity bonds or short maturity bonds? Which ones are affected the most by price movements? So if interest rates go up, the bond prices go down more for short-term bonds or long-term bonds? Which ones have higher price elasticity? Which ones are most affected by movements in interest rates? Long-term bonds or short-term bonds?
So it must be long term because we've been saying short term.
If it's a 2-year bond and the interest payments, the coupons are paid biannually, how many compounding periods is that? 2-year bonds,
So 4.
4 compounding periods. What if it's a 30-year bond? 60. Which one's most affected by movements in interest rates? Long-term bonds. 60 compounding periods compared to 4. Okay? So any movements in interest rates is going to move long-term bonds. Is this a long-term, medium-term, or short-term bond?
Long term.
Yes, more medium. Medium to long.
So what's considered long, like over 10?
Yeah, it's like 10, 20, 30. Corporations don't issue 30. They don't even issue 20.
Okay.
They probably issue 10. So long-term for corporations is probably 10. So this is really a long to medium-term bond. So do you think that there is a maturity risk premium for IBM? Are they raising capital under the short end of the term structure or on the medium term of the term structure? Medium. So are interest rates higher on the medium term of the term structure or on the short end of the term structure? They're higher on the medium. Okay, so they're going to be more sensitive to movements. So you have to add a risk premium for maturity. Are there other risk premiums? Could there be other risk premiums that affect the companies? Is IBM an international company?
Yeah.
Yes. Could it be affected by currencies
Yes.
changes, FX?
Yes.
If the corporate income tax is raised after the next Congress comes in, do you think that there's a tax risk premium that could be tacked on there? Yeah, maybe. And maybe there's other risk premiums that aren't even shown up that we don't even know about. So of these risk premiums, which ones do you think are the most important in determining the cost of the debt? Which ones are the most important? Have the biggest impact on determining cost of debt?
No credit.
Illiquidity,
Default.
risk default, and what else? Immaturity, that's right. Which one of those 3 do you think are the biggest? Which ones have the biggest risk premiums? Yeah. You got it. Okay. So now we can figure it out. So let's determine the cost of debt. So where is the 7-year, the 10-year treasury yield right now? Where's it trading right now? Where's it trading right now? You gotta come to class, every class in exactly that, where the stock market is, where the 10-year treasury is, where gold, where oil.
10-year treasury,
Yeah, where's it yielding right now?
1.66.
Yeah, something like that, like 1.7. Do you want to use that?
7 years, 1.58.
Okay, you want to use 1.7? Be conservative. Again, it's not going to make that big of a difference. You got to start somewhere. You want to use 1.7?
I think that's a clean number.
Again, at the end of the day, it's not going to have a major impact, but you got to start somewhere. Okay. All right. So credit default risk premium, you want how much? How many basis points do you want to tack on to the 1.7%? How many basis points do you want to add to the risk-free rate? How many basis points? How many basis points for the credit default risk premium do you want to add on to the 1.7%?
It's on their capital structure.
It does. They're pretty conservative. You know, they're probably AA or A or something like that, rated by Standard & Poor's. But you need to come up with a number. Is it 500 basis points? No. Is it 0? No. Is it 1.7? Maybe. But you have to tell me what it is. You have to think and figure it out. So give me a number. Or else we're going to be sitting here all night, wasting our time.
2.
Okay, so I got 200 basis points.
2.
200 basis points. 200 basis points. Right?
Yeah.
Right? Each 1% is 100 basis points. When I talk about risk premiums and when I'm talking about bond yields, I think in basis point terms, not in percentage point terms.
Right.
So when you're talking to people, they're going to be talking in basis points, and if you don't know what it is, you're going to be confused. Okay. So you want to use 200. Okay. What about the illiquidity risk premium? 0.5, and the maturity.
1.
Okay, so what do we got? 1.7, 1, 2, 3, 4.2, 5. Is that right? 5.2? Is it 5.2? 5.2? Is everybody getting that? Okay. So we got 5.2. Can I use 5? Just a round to keep the math easy?
Sure, yeah.
Well, either I'm going to round it up to 5.5, or I'm going to round it down to 5. You tell me.
5.
All right, 5%. And what you probably want to do is you probably want to go look at some 7-year IBM corporate bonds and see where they're yielding today. To go check. And go back to their financial reports, either the annual report and the footnotes, or go look at the 10Ks and find out when they were issuing 7-year bonds and what the yield and maturities were. That's going to give you a proxy too. Okay? But 5 sounds pretty good. Okay? Excellent. So now we have the cost of the debt. Now we need the cost of the equity. And how do I calculate the cost of the equity? What's the equation that I use for the cost of equity? How do I come up with the cost of equity? How do I come up with the expected return on equity? What equation do I use? Again, you have to memorize this stuff too. So I got to come up with the cost of the equity. So what equation do I use? Just give me the equation and I'll tell you what it is. Okay, test question, what's the base rate? What's the first variable within the cost of equity? What's the first variable? We need to build, right, the cost of equity. So what's the first rate that we use? What's the base rate that we use to construct the cost of the equity? What do we use? No, what do we use? In the cost of capital for the return on the equity calculation, where the cost of the equity, we have to start with something. So how do we build? I'm asking you.
Can you like cash flow?
No. I'm asking you to build me a cost of equity. All right. So how do you build the cost of equity to the firm? What's the first variable within the cost of equity calculation? No? No? No?
Cost of goods sold.
What is it?
Cost of goods sold.
No, don't guess. Okay, don't guess. Would I use the risk-free rate? Right? Yeah. And then what do I add? Don't I have to add something? No, that's gonna be in calculating the risk-free rate over there. Okay, but don't we have to add something, don't we have to do something here? Go for it. What's the equation? Okay, no, okay, you promised me you will remember this. You have to memorize this, okay? We've already gone over it. We used the capital asset pricing model. CAPM. So what is CAPM? What's the equation? You did it like 4 times in the homework and on the exam. So what's the next thing that you add on? What is it? Do I hear beta? I hear beta? Yes, and then what do I multiply it by?
The base rate.
Nope, it's already right there. So I multiply the beta times what?
One?
Yep.
No.
Should be in your notes like 3 more times. Okay, I'm gonna run out of time. Okay. It's gonna be the beta times the return on the market minus the risk-free rate. Okay, and what's that called? What's the model called? What's the model called?
Capital asset.
The capital asset pricing model, or CAPM, okay? You were gonna be asked this, okay? Finance and, you know, accounting majors, the investment bankers use CAPM to determine the cost of equity, okay? All right, so what's the risk-free rate? What did we say the risk-free rate was?
1.7.
Okay, 1.7. All right, and is IBM a big company? Yeah, does it trade on the New York Stock Exchange? So it's a big company that trades on the New York Stock Exchange. Is it in stock market indexes? Is it in stock market indexes? Yeah. So it's a big company, it's in stock market indexes. So what do you think the beta is for IBM? 5, 0, -5, 0.5, 1, 2, 3, 50? Any idea what the beta would be?
3 to 5.
No, that's a startup company. If the beta is 1, what does that tell you about the returns for IBM against the market? Does it move with the market or against the market? If it's 1, does it move with the market or against the market? If it's 1, does it move with the market or against the market? With the market, okay, with the market. So IBM is not a startup company. This is not Salesforce or Google. It's only been around maybe 10, 12 years. They've been around like 50 and 60 years, okay? Conservatively leveraged. Betas, big companies do not have betas of 5 or 3. They have betas of 1. So big companies, as they grow bigger, their betas start to converge to the market, okay? So to be conservative, you use 1. If you're going to use high-tech companies, you're going to use the higher betas because they're more risky. Their returns move more than the marketplace, okay? So we know that we're going to use 1. Now, what has been the average annual rate of return for the S&P 500 over the last 10, 15, 20 years? Again, we talked about it in class, so it's not like I'm saying it, what is it?
8 to 10%.
Yeah, like 8 to 10%, exactly. So what do you want to use, 8 or 10? 8? Okay. All right, and what's the risk-free rate? 1.7. All right. And what's the market risk premium? What's the market risk premium? Do the math. I'm horrible at math. What is this? No, it's not. What is it?
6.3.
Okay. 6.3 times a beta of 1. 6.3 plus 1.7. What's your cost of equity? 8? You've got the cost of the debt and you've got the cost of the equity. Okay. Now we got to figure out the weighted average cost of capital. Okay, weighted average cost of capital. And the way that we do that is we have to look at the capital structure. And what's the capital structure? Financial management students. Which you calculate optimal capital structures in your managerial accounting courses. You're looking at the balance sheet. You're going to have assets, and you're going to have liabilities. Now, do the assets and the liabilities have to equal each other?
Yes.
They do?
No.
No?
No, they don't. No, they don't.
Owner's equity's thrown in there.
Really? They have to match each other? Why isn't there such thing as a matching principle under the accounting rules? Under GAAP? Matching?
There is, but you have to include the stockholders' equity.
Yeah.
Yeah, I know. But assets and liabilities match each other, right? They have to equal each other, right? Oh, and did I tell you that this was a $10 billion company that we're trying to buy? And when you're looking at the value, the dollar values of assets and liabilities, are you using market or are you using book, historical cost? Are you using book or market? Book or market? No? Book or market? Book, exactly. Nice job. So yeah, you're gonna use book or historical cost of the assets and liabilities. Now, do you want to use short-term liabilities to finance long-term assets? Yes or no? No. Okay, excellent. Nice job. Do we know what the average capital structure looks like for a firm, how they finance the
640.
assets? What is it?
640.
Yeah, it's like 70-30, but let's use 60-40, okay, just to make it easy on us. So the equity component is going to be 40%, and 60% is going to be liabilities or debt that we're using to finance the assets. Okay. So give me, we know that this is what? How much is the equity? What is it?
40%?
It's 10 billion.
Yeah, 4 billion.
4 billion, excellent. Okay. And then can you give me some idea of how the 6 billion is distributed across the short, medium, and long-term debt? Is it going to be more towards short-term or more towards long-term?
So like
Long-term.
probably like 2, 2, 4.
2, 2, 4? All right. 2, 2, and 4. Is that right?
Oh, no, that's 8. So like 1, 1, 4. I got a little excited.
It's okay. Let's do 1, 2, 3. How about that? Just to make it look a little bit better. Okay. And then what are the assets going to be? If we want to match the economic lives with the maturity of the liabilities.
So we just match
Same
it
thing.
directly from-
Got it. 1, 2, and then 4, 5, 6, 7. Is that right? Like that? Does that look right? Yes? No?
That's right.
7,
No.
8, 9,
Yeah.
10. I'm using long-term debt and long-term equity to finance the long-term assets. So I'm matching the economic lives of the assets with the maturity of the liabilities. So this could be what is considered the target or the optimal capital structure. And if this is the target and the optimal capital structure, what's the goal? What's the goal of the optimal capital structure? What are you trying to do? What are you trying to do with your cost of capital? Maximize it or minimize it?
Maximizing.
So you want to maximize the cost or minimize the cost of capital? Minimize or
Minimize.
maximize the cost of capital? Maximize or minimize? Do you want to have a high cost of capital or a low cost of capital?
Low cost.
Low cost of capital. Okay? Because the equation, your IRR on your assets minus the weighted average cost of capital minimized by your optimal capital structure is going to maximize the spread between the two. If you maximize the spread between your internal rate of return and your weighted average cost of capital, you're going to maximize the stock price of the firm. You're going to maximize the stock price of the firm, which is the goal. The stock price, stockholder wealth maximization. And if you multiply the assets, the dollar value of the assets, either in the historic cost basis or in market value. Okay, you can do either of the two. What you can calculate is the dollar contribution, dollar return contribution on the margin from the assets. It's just the return times the assets. It's going to give you the dollar return in dollar amounts, not percentages, but dollar amounts. And if you calculate the dollar amount of the liability costs, you can calculate the spread. In dollar terms. And this is called, this is a very simplistic model. The goal here is you want to maximize that too. Once you get to the dollar amount, this is called the economic value add. Can I make investment decisions on the margin that will create economic value for the firm on the margin? Can I pick assets and acquire companies and acquire assets that are going to maximize internal rates of return? And can I manage the liability side of the balance sheet to minimize the cost of capital by understanding what our optimal target capital structure is to maximize the EVA? Now, the book does not talk about EVA. I guess you got to go to an intermediate corporate finance class to get it, but everybody I know on a conference call, when the CFO is talking, they're talking about EVA, but it's not in the book. So it's got to be mentioned here, okay? So now we have the weights and we have the cost of capital. Now we can calculate the weighted average cost of capital, okay? Because then now we can underwrite and go after that firm that we're trying to figure out if we should buy or not. So the WACC, weighted average cost of capital, is going to be, this is going to be our discount rate that we're going to use to underwrite the firm that we're going to acquire. So I know what the cost of the equity is. What's the cost of the equity? What's the cost of the equity? 8%.
8%.
Excellent. And then what's the weight of the equity? And you should start pulling out your calculator. I would pull out your calculators, pull out your phones. pull up your laptops and start doing calculations. And for now on, bring your calculators to the class, okay, because you're gonna pull them out. Okay, so what's the weight of the equity? What are we gonna use?
40%.
We're gonna use 30%, okay, 0.4. And what's the cost of the debt? What are we gonna use?
5%.
5%?
5%.
Okay, and then what's the, oh, shoot. We have to do two calculations. Can I tax deduct the interest on the debt? Can I deduct the interest on the debt that I pay? Can we deduct the interest, the coupon interest on the bonds? Can we deduct that? Yeah, wouldn't that be considered a tax shield?
Yeah.
Yeah. And then what's the highest corporate tax rate, just to use it?
35.
Yeah, it's like 35, minus 0.35. And what's the weight of the debt? 60?
Yeah.
6. Okay, so what's my weighted cost of equity and what's my weighted cost of debt? And we're going to do the before and after the tax shield. Okay? Because what happens is when you put in the tax shield, it drives down the discount rate. Really too low in my view. So what's 8 times 0.4?
3.2.
3.2. And then what's 5 times 1 minus 0.35 times 0.6?
3.25.
What is it?
3.25.
Is everybody getting that? I want to make sure everybody gets the same thing. Are you getting the same calculation?
I didn't have the last one, but I know.
I need validation verification. I can't rely on one person. Are you getting the same thing? Are you getting the same thing? Okay. You guys need to check my numbers. Is that it?
I didn't get any of that.
So it's what, 6.5?
Wait, what?
6.5?
I got one. You got
3.2 plus 3.3, and then, oh, I didn't multiply by 0.6.
Oh, you didn't?
No.
Oh, so
I
you
got
no.
1.95 for both.
What is it?
1.95 for both times I did it.
So it's 2?
Yeah.
So their weighted average cost of capital is 5.2. Okay. That to me seems pretty low. Why don't we get rid of this? If I get rid of the tax shield, am I being conservative? Am I being conservative? Or am I being liberal in my assumptions? If I get rid of the tax shield, what does the tax shield do to your cost of debt? Does it make it more expensive or less expensive? Less expensive. So if I get rid of the tax shield,
You're being
is it gonna,
conservative.
I'm being more conservative?
Yeah.
So, because 5.2 seems a little low, so why don't I be a little conservative? So what's 5 times 0.6?
3.
Point,
What is it?
Yeah,
3.
not much higher than
Okay, so basically 6. Right, so without the tax shield, I'm using a 6. With the tax shield, I'm using a 5.
that.
Right?
Is that like a huge difference?
Not really, but I'd rather be conservative.
Okay.
But what you're gonna do is you're gonna run, when you're calculating these WACs, you're not gonna just use 1, you're gonna use the sensitivity. So you probably use 5, 6, 7, okay? But we're not gonna do 5 and 7, we're just gonna do 6. Okay, so we're gonna do the midpoint. But if we were running this in Excel, we would do 5, 6, 7 would be our sensitivities on the discount rate to calculate the net present values and present values. But let's just use 6, okay? Just for to make things easy. Okay, so now we got the weighted average cost of capital. Now we can basically do the investment analysis. And I think I can do it. How much time do I have left?
25.
25?
Yeah.
Yeah, I can do it in 25. If you guys help me with the calculation. I can't do all the math and stuff in my head. Okay, so we want to buy this company. They're IBM. We know our discount rate is 6% that we're going to use to discount the future cash flows. And when we looked at this company last year, T equals 0. Their free cash flows, we used EBITDA because they're a small firm and I want to use free cash flow. We knew that their free cash flows was $100 million. So it's a pretty it's a pretty big company. We're not buying a, you know, a unicorn or anything like that, but this is a pretty established firm that we think that it can contribute to our revenue growth. Okay. So we want to be able to calculate the present value. And we'll do a 5-year holding period. So 1, 2, 3, 4, 5, okay. We want to set up the discount rates. And maybe you can give me the discount factors. I know that this is 1.2. 1.06 to the third power, what's that? What's 1.06 cubed?
1.19.
1.19, is that correct? Okay, I'm not going to take answers from one person. Is that right? Is 1.06 cubed 1.19? You gotta know how to use the exponential. Is that correct? Thank you. Okay, 1.06 to the fourth power, what's that? It's 1.06 to the fourth power.
1.26.
1.26. And what's 1.06 to the fifth power?
1.34.
1.34. Okay, got it. So I got the discount factors, I got the things set up. How much do you think, once we take over this company, how fast do you think we can grow EBITDA from last year to this year? Taking over this company, you're IBM, you guys are really smart, you've been around a long time, you know how to take over companies and turn them around and make them even more profitable, right? Because you got IT, you got distribution channels, you got HR, you got smart people, you got systems. How fast do you think you can grow these free cash flows from last year to this year? 10? Okay. 1.1, right? So that's what? 110 million? What do you think you can do from 1 to 2? What's the growth rate? This is exactly how it's going to be in the meeting, okay? They're going to be asking me these questions. So we're just practicing. So how fast do you think you can grow the free cash flows from year 1 to 2? You got to say something, okay? You got to say something. Saying nothing doesn't do anything. We need to get to answers quickly because I'm running out of time. Okay. Okay, so what's 110 times 1.1? 121. Okay, and then what can we do from 2 to 3?
Or
You
like,
think?
can we do 8%?
Maybe more.
Maybe go down?
Yeah. I mean, do you really think that you can grow free cash flow that fast over that period of time? You guys better be really good, or these guys better be super good, right? And there must be huge demand for their product. But let's do it anyway. Okay, 121 million times 1.08.
130.7.
130?
Yeah.
1? Yeah, just round up.
Okay.
From 3 to 4?
7.
What?
7%.
Be careful. Be careful. Personally, I don't think you can do it. I'm not going to grow out the revenues, you know, almost 30% over 3 years. That's crazy. You're probably going to get maybe 10%, maybe 30% in the 3 years, but what's the probability of really being able to add that much value in a company over that period of time? You're probably going to do it in the first or second year, not in the third year.
So what, now we're going up, what, maybe 2%, or is that 2?
That's too low.
Okay.
That's too low. Yeah, probably 5. And then what's 131 times 1.05?
138.
138? Okay.
Yep.
And then what about from 4 to 5?
4.
1.04. And what's the number?
144.
144. Now, do we just discount back these cash flows to get the present value, and that's the value of the firm, or do we do something else? Yeah, we probably need to do a couple more steps. What's the next step? It was on your exam. It was the very last question on your exam. You got to figure out the terminal value. Excellent. So we got to come up with the terminal value. Okay, and how do we get the terminal value? This is the most important part of the class right here.
Present value plus the year after.
So we gonna grow it out one more year? Okay, so what do we wanna grow the, last year in the holding period out by what growth rate?
3%.
And what's 1.03 times 144?
148.
148. All right. Now, what do we do with that? Do we just add that here and discount it back, or do we have to do something else? Is that the terminal value, or do we do?
Divide it by the 6.
Okay. Now, do you want to assume that the cash flows are going to be flat forever, or going to grow at a constant rate?
Grow at a constant rate.
Okay, so what model were you going to use? What model do we use? We're gonna, these cash flows are gonna grow out into the, forever, either flat or at a constant rate. If it's at a constant rate, what's the model?
I plus G.
Yep, and what's that called? The model, what's the model name? What's the model called?
Gordon growth.
Exactly, Gordon growth, okay, excellent. And do we want to use the same discount rate? Or do we want to use a higher or lower discount rate? Remember, it's 6 years later, right? Is there more risk 6 years later than today? So do you want to use the same going in discount rate or a higher discount rate? Probably a higher one to reflect the risk. So how many basis points do you want to add on to the going in discount rate to get a terminal discount rate? How many basis points? Come on, hurry up, I'm running out of time. 50? 100? 200? 500?
100. 100.
100? That's a .07. So what's your forecast of the free cash flows in which they will grow out forever at a constant rate? It is a tech company, so if it's run well, then theoretically the cash flows could grow at a constant rate into perpetuity. What rate do you want to use? Well, you can't use 0 because that's perpetuity, right? If you use a really high growth rate, then the terminal value is going to be so huge that the present value is going to be really big.
Is 8% too low?
Way too high. Probably 3. So what does that make it? 0.07 divided minus 0.03.
0.04.
So what is 148 million divided by 0.04?
3,700.
What is it?
3,700.
3,700?
Well, it's 148 divided by that.
0.04. 148 divided by 0.04. What is it?
37.
Is that correct?
Yes, sir.
Is it? So it's 3,700,000,000?
Yeah,
That's a lot.
yeah.
We use it. Now what do I do with that terminal value? Now what do I do with the terminal value?
Add it to your C.
So I spread it out over these 4, or what do I do with it?
Add it to the end.
Add it to the last cash flow in the terminal, in the last cash flow in the holding period,
Yeah.
correct? Okay, so what's 3,700 plus 144?
One.
3,844,000,000, is that correct? What's 3.844 divided by 1.34? So it's 3,844,000,000 divided by 1.34.
2868.
2868.
69.
Yeah, I'm not gonna do it. Okay, and then what is 138 million divided by 1.26? What's 138 million divided by 1.26?
110.
Does it?
Well, I got 109.52, so round it up to 110.
Thank you. And what is 131 million
Is that
divided by
right?
1.19?
100%.
Is it?
Yeah.
Yeah, I need confirmation, because I don't want to have to go back and redo this. One time in my class, they screwed it all up and they made me go back, after I spent like 30 minutes doing this stuff.
Yeah.
121 million divided by 1.12.
Oh, no, wait.
Mhm.
Yep.
And what's 110 million divided by 1.06?
104.
What is it?
104.
104 plus 108 plus 110 plus 110 plus 2, 868. So basically, 3.3 billion. Is that right? Is that what we came up with? That's the value of the firm, based on our underwriting assumptions? So we talked to the seller. They want $4 billion. What's the net present value? What's the NPV? What's the net present value? 700 million. Is it positive or negative? Is the net present value positive or negative? What is it?
Negative.
Negative. Are you going to accept or reject it?
Rejected.
Reject.
Less.
Hold on, we'll go through it. How much time do I have?
15 or 10.
10 minutes? Okay, perfect. All right. So we talked to the sellers, they want $4 billion. But we're coming up with a present value of 3.3 billion. Okay? So we're getting a negative net present value of $700 million. And under the investment decision-making rules, we would reject it. Okay? But we really want it. Okay? So what do we do? Well, we would do what? I mean, it's not, we're not building a project, we're negotiating with another company. So we'd ask for a lower price. We'd ask for a price reduction in what amount?
700 mil.
That's it. So we get a price reduction. And if we can get a price reduction of $700 million, what's the net present value? What does it turn to?
0.
0. Do we accept or reject?
Accept.
Accept it. Sorry. Those guys won't budge on the price. But we really want this project. So what do we do now? What would we do now?
Rework that
The
numbers.
model is correctly projected.
That's right, we go back and look at the model. So what assumptions would we go audit to see where we may have made a mistake?
The percentage we used for
The growth.
the
You know,
growth.
the growth
yeah.
rates?
Mhm.
So we go back and look at the Gs per year, right? Well, maybe we underestimated the G. We were at 10% per year.
The first 2 years, 3
So if the growth rates go up, what happens to the present value?
Goes up.
It goes up, and what happens to the net present value?
Goes
It
up.
goes up. Okay, excellent. No, it goes up.
But then when,
Now,
So
if the
what-
growth rates go up, the numerators go up, the present value and the net present values go up.
yeah, so then would that help us at the end to be
Yes.
closer to the 4 billion?
Yeah.
Okay,
So we're auditing the underwriting right now.
Yeah.
Okay, what other variables would we look at? What? Yeah, the discount rate. Maybe your capital structure's not right, or maybe your estimates of the cost of debt and equity. You know, maybe we overestimated the beta, you know, or overestimated the return on the market, or overestimated, you know, higher interest rates. Maybe we screwed up on the I. So we have to go back and look at our weighted average cost of capital calculation. Anything else? Any other variables in here that I could audit? There's a couple more. Where did we touch this model? This is the discount rate right here. Okay, the going in discount rate here. This is the growth rate in the cash flows. Could we have underestimated the terminal value? Yeah, and if we underestimated the terminal value, where did we make our mistake? Do we over or underestimate the terminal discount rate? Do we over or underestimate it? Do we over or underestimate it? Over or under? Was it higher? Was it too high or too low? High or low? If the discount rate goes up, if this goes up, what happens to the terminal value? It goes down. this is underestimated, what is the value? It's underestimated. So we could have overestimated that and underestimated that. Couldn't that have affected the terminal value? And is that gonna also have an effect on your present value and your net estimates? Excellent. So, bad news. We went back, we looked at all of the assumptions, and you guys were right, you did all the calculations correctly, and the underwriting is correct. But we really want this project. So what do we do now? Yeah. You would calculate the real call option. Okay? You would calculate a real call option, and it's in the book. You would calculate a real call option. And what is the value of the real call option need to be? What does it need to be to get this project to work so that you can accept it? What does the real call option need to be? The value.
It's 700 million?
700 million. Yeah, so if your real call option is plus 700 million, then what is your net present value equal to? Do you accept it or reject it?
I think so.
Okay. And the value of these real call options are driven by three things. Management decision, decide when they want to buy this company. Value volatility. Are tech company stock prices, are they volatile? Yeah, they are. 1 minute they're worth a ton, next minute they could be worth something less. So the volatility in the price. And then time. Does the management have to do the acquisition right now? Or can it wait a little bit? Could it find maybe similar firms like that in the future? So they have time. So there's time value. So they have time. Can we put in an offer, maybe a letter of intent to at least lock us into the contract, to negotiate, to buy the firm, to give us some time to figure out the real call option value to see if it's plus 700 million? Would that give us some time? Yeah, it would give us some time. And do we have to buy the firm right now? Can we close on it in a year from now? Maybe. So that ability to negotiate and the volatility and the time value is going to determine the real call option value. And if the real call option value is equal to or greater than the negative net present value, then your net present value is equal to 0 or greater, and that means that you can accept the project.